Welcome back to the channel. Today, we go through the maze of common investment mistakes that can hinder your financial success. We will unpack these pitfalls, examine their nuances, and equip you with the strategies to navigate the investment landscape more confidently. Investing is a rewarding journey, but it's chock full of potential pitfalls. By understanding these 13 mistakes and their implications, you can solidify your financial strategies and pave the way for a more robust investment portfolio. Investment mistake 1. Neglecting to start. Procrastination in starting your investment journey can significantly impact your future wealth. Starting early and consistently contributing even modest amounts can harness the power of compounding and most definitely result in substantial growth over time. Facing early career challenges like student loans and lower salaries can hinder your ability to invest during your 20s and 30s. However, making the most of contributing early to investments taps the power of compounding. By controlling expenses and prioritizing investing in yourself, even modest contributions can grow into substantial wealth accumulation through compounding over time. Investment mistake 2. Not having an adequate emergency savings account. An emergency savings account might not seem directly related to investing, but it serves as a crucial buffer. Insufficient emergency savings could force you into debt or even to dip into your investment during unexpected expenses, leading to potential taxes, penalties, and a setback in your investment goals. Having 3 to 6 months worth of expenses saved in cash and cash equivalents can safeguard your investments and financial stability. Number 3. Expecting too much. Let's talk about the allure of unrealistic returns. Many investors fall into the trap of expecting astronomical gains without considering market realities. By setting reasonable return expectations, you align your investment strategy with achievable goals, thereby avoiding emotional roller coasters and impulsive decisions when the market doesn't meet your inflated expectations. 4. No investment goals. Investing without clear goals is akin to sailing without a destination. Without a well-defined plan, investors might chase short-term gains or blindly follow market trends. Crafting specific, measurable, achievable, relevant, and time-bound investment goals provides direction, serving as a compass through market fluctuations and reducing the propensity for emotionally driven decisions. Investment mistake 5. Not diversifying. Yes, diversification, a fundamental principle often overlooked. Failing to diversify can expose your portfolio to undue risk. Allocating investment across various asset classes, industries, and geographical regions helps mitigate risk and shields your portfolio against substantial losses when a particular sector or asset underperforms. By diversifying your investments, you enhance the resilience of your financial holdings. Investment mistake 6. Focusing on the short term. Short-term focus often derails long-term investment success. Investors can succumb to the temptation of reacting to immediate market swings, leading to hasty decisions that undermine their financial strategy. Staying committed to a long-term vision prevents impulsive actions, ensuring a more stable and rewarding investment journey. Number 7. Buying high, selling low. Buying high and selling low is the nemesis of investment success. Emotional reactions during market volatility often prompt investors to sell during downturns, locking in losses. Maintaining a disciplined approach and avoiding knee-jerk reactions can help ride out market fluctuations and will generally lead to better long-term returns. Investment mistake 8. Trading too much. Active trading might seem enticing, but studies show that excessive trading often results in underperformance compared to a more passive buy and hold approach. By minimizing unnecessary transactions and focusing on your strategic long-term investment plan, you can avoid the pitfalls of frequent trading and potentially enhance your portfolio performance. Investment mistake 9. Paying too much in fees. Fees, even seemingly insignificant ones, can significantly eat into your investment returns over time. Opting for low-cost investment vehicles or platforms can maximize your gains by minimizing expenses. Being mindful of fees and seeking cost-effective investment options is crucial for long-term wealth accumulation. Mistake 10. Focusing too much on taxes. While tax considerations are important, making investment decisions solely based on tax implications may not align with your broader financial objectives. Balancing tax optimization with your overall investment strategy ensures a more comprehensive approach to wealth creation. 11. Not reviewing investments regularly. Regularly reviewing your investments is akin to giving your portfolio a health check. Neglecting this crucial step can lead to misalignment with your financial goals or missing opportunities for rebalancing. By evaluating your portfolio quarterly or annually, you can ensure it remains aligned with your investment objectives and make necessary adjustments. It is surprising how many investors aren't fully aware of their investment performance. Tracking your returns, factoring in fees and inflation, is essential for evaluating whether your investments are meeting your goals. Keeping a close eye on performance helps you to stay on track and make informed decisions. Mistake 12. Misunderstanding risk. Understanding risk is pivotal in crafting a well-balanced investment strategy. Too much risk can lead to sleepless nights, yet too little risk may lead to lower returns that fall short of your financial goals. Finding the right balance, tailored for your risk tolerance and financial objectives, is key to successful investing. Investment mistake 13. Investing with emotions. Media frenzy and market news can evoke emotional responses, often leading to rash investment decisions. This can be hazardous. Emotional decisions often lead to impulsive actions, which might not align with your long-term strategy. Staying rational and disciplined during market fluctuations while maintaining a long-term perspective is vital for consistent and stable investment performance. Thank you for joining us today as we dissected these crucial investment mistakes. By understanding these pitfalls in details, you are taking proactive steps towards securing a more resilient financial future. Remember, investing is a journey that demands continuous learning and prudence. For more insightful content on mastering your finances, subscribe to the channel. Until next time, stay financially savvy. We'll see you in the next video.